Super microcomputers, a stock that was flying high and now it's crashed to earth with over a 50% drop. Will the stock recover or will it dwindle into insignificance going into the future in the coming years? Well, that's why you're here to find out right here at Barry Charles. Yes, welcome guys and girls back to the channel. In this episode, we will discuss super microcomputers. We're going to do a stock analysis and intrinsic value. But first off, we will talk about the business. We'll look at the business as a whole. We'll look at the business model, see where that's at, how they actually make their money, folks. Then we'll look at two positives, two negatives of the growth of the stock going into the future. And as I said before, then we'll do a deep dive into the stock analysis of this company, look at the financials of return on invested capital, revenue, net profit, and everything else in between. And then right at the end of this video, we will give you the intrinsic value of Super Mario computers. Not financial advice. Do your own research before you enter any stock, buying any stock. Let's get to it. Yes, super microcomputers. Not to be mistaken with Super Mario Brothers. Did you just hear the tumbleweed go past? All kidding aside, let's get to it. Super microcomputers. What is super microcomputers? Basically, what super microcomputers is a global leader in the high performance of energy efficient servers and storage solutions. So what does that mean in layman's terms? So they specialize in server hardware, data center solutions, and cloud computing infrastructure catering to the likes of AI, super cloud services, and telecommunications. Super micro business model. What's this all about? Well, mainly it operates on its hardware model, but they also have the integration of some software in their services. It makes money through service sales from their storage systems, motherboards, and cloud computing. They also make money from their customizable solutions, providing tailored hardware configurations to AI startup companies. They also sell direct to the consumer, to large enterprises, and also how they make their money is by service and support offers after sales market. So whenever they need some IT support, some maintenance, they are there to take the money and fix your problems. So yes, that's a little bit about super microcomputers and what's happening in their company. Let's now look at two positives and two negatives of the growth of this company into the future. Positive number one, AI and cloud competition boom. With the rise of AI applications and cloud computing, demand for high performance out of this world servers have surged in popularity, which will make super micro great revenue. Number two, in terms of positive growth, customization and agility. Unlike competitors like Dell and HPE, Supermicro modular and flexible hardware approaches allows it to rapidly respond to customers' needs, giving them more market share as they have a more better product into the future. That is what they hope to do. So now we looked at some positives. Let's look at two negatives for this company. What is going to drop the growth in this company going forward into 2025 and beyond? Well, supply chain risk. So they are heavily reliant on chips from Intel, AMD, and of course NVIDIA. If they see a slowdown in that means their production line comes to a halt, and the pressure on them to continue is limiting their growth into the future. Also, it's been a highly competitive, so the number two negative is that space is getting way more competitive, and you already have the likes of HP, Dell, and Lenovo being in in the sector a lot longer than super microcomputers, meaning that there's a lot of chance for price battles, which will hit into the bottom line, low margin growth, which is a big issue for this company going forward. But on the positive side of all that, they have a technology boom that is helping them, as they were an early adopter of the cutting edge technology, hardware of AI of the sort of CPUs, as well as liquid cooling solutions, appealing to the higher echelon of computer systems. They want quicker and quicker, so they are on top of that. So that's something exciting. There's something good about the company, but there's a lot more they need to do in terms of growth. So now we understand a little bit of positive and negatives of the company. Let's have a look at the stock. What's actually the stock doing? So let's do a stock analysis now. We'll look at return on invested capital, PE ratio, free cash flow, everything in between, to find out if this is the stock for you. This is not financial advice. Do your own research before you buy any stock. But let's get to it. What is actually happening for this company right here, right now on the channel? Yep, Super Micro Computers is sitting at around a $56 stock at time of recording. Down 23% on the year, but up over nearly 2,000% over the last 5 years. So if you got in the 5 years ago, you would have made 2,000% basically outstanding. So the 52-week range, this has been unbelievable. $122 at the top, and as low as $17, folks. And this is just in the last year. So you could have been paid basically a triple, nearly. Currently, not quite, but yet 2.5 at least. If you bought a 17, or you're down over 50%. So interesting times for you out there. If you were in the company, you would have been on a roller coaster year. If you were holding on, hopefully you hold on and keep buying at the dip, then you're really just smooth sailing all the way to the top of the pyramid, potentially, or maybe not. We will see. So PE ratio of 21, so they're not expecting too much growth for this company. Earnings per share 2.6. No dividend to speak of, and a high short interest of 15%. So 15% of people out there think this company's going bust. Market cap 32 billion. Shares outstanding 506 million or 586 million, which is actually down from 6.4 billion. So they're actually starting to decrease. Before they were flying high. They keep rising it up, but now they've had a bit of a dip. We're starting to see a little bit of a dip. Let's hope that continues for you investors out there. Now let's have a look at what else is happening. Their return on invested capital, what's happening there? They really need to work on their return on invested capital. No, they don't. 30%. Can you believe it? 30% of $1, 30 cents is actually making money. That's outstanding. So why is the stock so low? Just does not make sense at all, folks. Well, when you look at the free cash flow of negative $500 million, that's when it all crashes and burns for you. They're not making any money. Or are they? They're making money, but they're not making money in the free cash flow sense. Well, let's check out what's happening with Super Micro Computers in terms of revenue. So revenue, 15 billion last year, up from 7 billion and 5 billion, outstanding. So basically a double up from the year before, so outstanding. Net profit of 12 billion from 640 million to 285. It's outstanding. What's happening with this company? Why are people not investing? If we look at quarterly with the revenue, 5.3 billion, 3.8 billion, and then 3.6 billion. But this is when it gets a little bit choppy here in terms of net profit for Super Micro. 552 million in the last quarter. The quarter before that, 402 million, and 296 million the quarter before that. So a little bit choppy there, and that's probably why you're not seeing the stock just going smooth sailing up. In terms of the total assets, 9.9 billion, up from 3.6 billion, so really have skyrocketed in total assets. The same with total liabilities, from 1.7 billion to up to 4.4 billion, so they really are flying up with that. So what does this mean? Well, we got to check it out right here, right now. Intrinsic value of super microcomputers. What is happening with this company right now? Is it worth a buy? Is it overvalued? Is it undervalued? Well, you're going to find out right here, right now. We're going to calculate intrinsic value using the current share price, earnings per share, expected growth rate, and current bond yield gives you a calculation of what intrinsic value could be here right now and into the future. So I'm going to do a bear case, a base case, optimal case, flying to the moon, and out of this world case for you. So 5 different points of view in terms of where the company bear case will be if it's struggling, and then if it's going to fly to the moon, where it's at. Well, let's do this right now with super microcomputers. Let's check out what the intrinsic value is. So we're going to look at bear case first at $56 a share. Earnings per share are $2 at 10. A 10% growth rate, you're looking at $59 stock. So roughly where we are now, and that is base case. Bear case, sorry. If we look at the base case, $56 at 2.6 earnings per share. So this is where they're at right now. With a 10% growth rate, you're at a $77 stock. Interesting. So we go to optimal. So we're going to ramp the earnings per share up to $4 and 15% growth rate. You're looking at $160 stock. So we're starting to see some excitement. Then if you think it's going to fly to the moon, earnings per share is going to go from 2.6 to 8. At 20% growth rate, you're looking at a $400 stock. But if you look at the growth rate future, we will see if we'll get to that. And then if we're going out of this world, 56 the current share price. We're doubling the earnings per share to 16 instead of 8 from the last calculation. And 25 growth rate, you're looking at $975 stock. So what does this mean? Right here, right now, potentially it's undervalued, but not super undervalued. So where's the future? If you want to say exciting stuff into the future, you're seeing a 3x of this company? Maybe. But it might be 10 years away. It could be 3 years away. Depends if they can continue to grow. And I expect this growth to slow. I don't see this company being at 20% every single year. If you think the stock's going to be that, I would probably just run away. I don't think that's going to happen. It may happen the next year or two, maybe. But going forward, I don't see that continuing for here and beyond. But yeah, 3x potentially is where I'd see it from here. So does that mean you could buy it? Yeah, potentially. But it could take you 10 years to get there, which is 30%, which is not bad. Don't get me wrong. There's will be worse stocks out there. But do I think it's going to be the one that changes your career? If you bought it early on, obviously. But if it dropped to something ridiculous again, if it dropped down to $15 or something, and you bought it, then you're starting to talk. So it's all about price matters, right? If it's just crashing for no reason and the fundamentals are still good, then potentially this is the stock for you. But for me, I am staying out of it for now. Super microcomputers is not, I'm not invested in the company, just to let you know. But that's a deep dive into stock analysis and intrinsic value of super microcomputers. I hope you enjoyed the video. Remember to like and subscribe to the channel and share it with all your friends. And I'll be back here each and every week with 2 videos just for you.